Hi, this is Mark Carrington. In this video I'm going to talk about a stop loss strategy for FX spot positions, foreign exchange spot positions, which have resulted from an exercise of a foreign exchange option. I'll do it by example, so it always works the best for me. What I have here is an Aussie US chart for an Aussie US dollar put contract. The face value was $10,000. It was bought on the 10th of November. The expiry was the 1st of December, so the exercise date was the 1st of December or the 2nd of December, because that's the trading day. That's indicated by this big blue arrow. The strike price was 86.45. Do need to subtract the spread, so the entry price for the trade was 86.39 in this particular case, and the premium I paid on this contract was 0071, so 71 pips. So the first thing I want to do is I want to know what my break even is for the trade, because once I have got my stop losses better than break even, I will change my stop loss strategy. So the break even in this particular case is 8639 minus 71, which gives me 8568. So I will draw a line 8568 on the chart. I'm already done one of these, so I'll just have to show what it is, and there it is. You'll see here that there is 8568 is the red line. So the first thing I want to do is put a stop loss above the high on the day that we entered the trade, which is above this bar here, just below the blue arrow. What size stop loss should we use? Traders use all sorts of stop losses, as low as 5 pips, 10 pips, 15 pips, 20 pips. Those are all somewhat discretionary numbers based on their experience. A nice model, and particularly a model that's pertinent in the current environment, is to use the average true range, which is a measure of what the instrument has, what its daily range has been averaged out over a period of time. So I've inserted here an average true range chart. It's over the last 14 periods. You see there ATR 14 where my cursor is. And what we'll see, as we'll certainly notice, is that from September this year, see how ATR has dropped from the 47 level. You can see the numbers on the right hand side, and it is almost gone. It has gone beyond a double. So the average true range. So that's just an indication of how much volatility has increased. So if we take here the 2nd of December, the day we're entering the trade, and I'll bring the cursor down so we cross directly there, we'll see that the average true range was 99 pips. So we could use one average true range. A nice rule of thumb, and it's a rule of thumb only, is to do 1.5 times average true range or twice average true range. So let's, for the purposes of this example, we will use an average true range of 1.5 times ATR, 1.5 times ATR. And maybe what I'll do is I will add that into this box here, and I will say ATR 1.5 times, which starts out on 212 at 150 pips. We'll hit OK, and we will now see that that's captured for us. So what we'll be looking at then is on this bar here, which is our entry bar, which had a high of 8541. 8541 add 150 gives us 8691. So we're going to put a stop loss in of 8691. So let's draw that one in, 8691. I'll format that one, we'll make it yellow, and we will, yes, that's a different color, and we will make sure that I've got exactly the right number, 8691. Okay. So that will be our starting stop loss. Now our objective is to get our stop loss below this break-even line as fast as we possibly can. Now one of the techniques that we can use is to do that when we have a series of bars in the right condition. So we have here, we have a seller bar. You can see that the close is right down at the bottom below halfway. We have another seller bar. We could choose to move after 2 seller bars. We could even choose to say after 3 seller bars. So let's do that. So we'll do 2 seller bars in a row. We'll take this one here, which is the, I'll write that high down there, is a high of 8465, and we will do 1.5 times ATR at that time. So 1.5 times ATR there, we've got 97, so we add 45 to that, 47 to that, what gives us 130. 97 plus 45 is 137, 142 pips. Added on to 8465 gives us 8607. That feel like good mathematics. 8607. So we're now going to move our stop loss to 8607. I'll make sure it's in the right place, 8607. So we now see our stop loss has now entered, is now below our strike price, our entry price, but it is not yet past break even. So we've based it on that chart there. We have actually now we have 2 more seller bars. So I can then do on the 4th of these consecutive seller bars, I can now do the same again. So on this one here, I have a high of 8392, and I have an average true range at that point of 95. So I'm going to do 1.5 times that. So 95 plus 45, 46. 95 plus 46 is 151, 141. 141 pips on top of 8392 gives me 84, gives me 85. I should really do this the other way around, the way you taught at school. 8533. No, it must be 8433. No, 8533. 8533 is where we're going to go. So this one is going to move to 8533. I'll format that so it says 8533. So now we have moved to stop loss after 2 seller bars and again after 2 seller bars, and we are now better than break even. At this point I am going to change my strategy. We now look at the second part of our stop loss strategy. Is that once we're at break even, we're now only going to move our stop losses, and we're on the way, when we're heading down, we're going to do it when we reach a swing high, and when we're heading up, we're going to do it when we reach a swing low. So here we're heading down, so we're looking for swing highs. And so what is a swing high? Well, basically what we're looking for is when we're running down like this, we do a retracement. We do not want to be taken out on the retracement, and we want to protect ourselves above the next turnaround. Now this is a really uncomfortable time as a trader because you're watching your profit reduce as it retraces. But if we can get the swing lows, the swing highs properly identified, it leaves open the opportunity to participate in the further extension of this run. And if we take this previous run here and if we'd had a stop loss at 1.5 times ATR, we could well have been above this one. We would have moved it again and still been above this one, and may have survived this one and been able to participate in this continuing run. So that is what the objective is. So let's just draw quickly for a swing high. Basically is we get a bar that does that, we do have a bar that does that, followed by a bar that does this. So we have here a higher high and a higher low, followed by a lower high and a lower low. And then our stop loss is going to go in above that swing high. Now just the quick reverse of that, if we're heading down, I will draw those quickly on the chart for you. We're running down like this. We make a lower low and a lower high, and then we get a reversal and we get a higher low and a higher high, and that is called a swing low, and our stop loss will then go in underneath there. So let's do it by example on this previous rundown here, and to see at what point would we have moved that stop loss. We're looking for swing highs. Right, so we're now running here, so we're looking for situations where we have a higher low and a higher high, followed by a lower high and a lower low. So we have one here. You can see this here is higher than that one. That's a higher high, so we certainly have a swing low here. So then what we would do is we'd be looking at putting our stop loss in above that at a level, let's say 1.5 times average true range, if that's what our strategy is. And then we will only move that again when we have another swing high. So as we run through here, this is not a swing high, even though it made a higher high, because it made a lower low. This is an inside bar. This one, so we have none here until we reach, and we really want it to be a confirmed swing high. This one here made a lower low, so I would not be comfortable calling that one a swing high. The next one would be this one here. So we could go in there and put a stop loss up above. In fact, I wouldn't do it there either, because that bar made a lower low. So this is a question of really being patient. You have to wait until this bar has completed before you make a decision that this one is the one you're going to go for. We now have 4 bars that run against, and then we have one that clearly makes a lower low, lower high. So the next one I would be looking at is this one here. And we head down, which is the direction we want to go. We head back up, and then we have another one emerging. Is that one there? No, because this is an inside bar. So we're still sitting back there. So we're now heading. In fact, the next one is here. Although this is a very strong sideways range, it's not always helpful to just move stop losses in a sideways range. But let's just be consistent with the rule. It is a swing high, so we could put one across there. So if I then move along here, if we were 1.5 times average true range here, we would be up here, and there's a good chance we still be in the trade. The next one is up here. So we're now sitting up above here. Probably not had to move stop loss there. We would have survived that one. And then as we run down here, this is an engulfing bar, and the next one is this one over here. So we move the stop loss there. We've survived this scare here. This scare here. And we're still in the trade, and we can participate in this run downwards. And then the next one is just before here, and we're heading down, although this one's an inside bar. So again, technically you could see it's very easy to get these things confused, but that's the concept. Is basically we're going to go to that one there, run down to that one there, and if we're wide enough, we survive that one, and we move to that one there, and then to this one here. We probably need to survive, so we wouldn't move the stop loss. We'd never widen a stop loss once you're in. So we've survived that one because we were up here. And then the next one down is this one here, which is a little bit down. And then this one here. No, this is not one there. There's one there. That one is there. And we are participating. I hope that helps.